Anthony, let me just take a step back and pretend we're flying at well, now we could go up with Branson. So 30,000 feet's not high enough. Let's say we're at like 150,000 feet. What do you think where should rates be if there was no COVID, based on where the economy is right now and based on 100 years of history? That's what I have trouble dealing with, because I was used to 6%, 7% in a good economy. And I mean, is the terminal place where we're going 2.5%? Is that a normal world, Anthony?
Sure. I think you hit the nail on the head here. If we didn't have COVID, rates would be materially higher. In fact, we are very bearish on duration here. We are underweight the front end of the curve precisely because we think that rates are going to move higher over the course of the year. While it may be tactically advantageous to cover a little bit of the underweight in front of the Fed, we think that the direction of travel is firmly higher, given the fact that the economy remains robust. You look at the labor market, unemployment rate is 3.9%, which is below the Fed's assessment of full employment. So we think that rates should march materially higher. We can see rates going as high as 2.5% by the end of the year.
Anthony,
in the 10-year space.
In the 10-year. Anthony, do you think the Fed is the cart or the horse at this point? Will the Fed just be catching up with where the market takes it, or can it actually get out in front and actually be control its own destiny, so to speak?
So we've been arguing for the last 6 to 9 months that the Fed was falling behind the curve. And I think what you've seen in the last month to 2 months is a recognition of that by the Fed. Initially, if you look back 6 months, the Fed wasn't even pointing to one rate hike in 2022. Now you see that the Fed, in their December statement, has basically pointed to 3 hikes. And if you look at the recent hawkish Fed rhetoric that has come out, now they're suggesting that 4 hikes can be on the table. And not only 4 hikes, but the inception of balance sheet runoff, they're also anticipating could be on the table for the rest of this year. So I think it's a combination of both. I think you see the market is getting more worried about inflation, and it's causing increased consternation from the Fed. And now you see they are trying to catch up to where the economy fundamentals truly are.
Anthony, in the history books, the last 20 years, would you say have been a period of secular disinflation? I think we can safely say that now. Wouldn't you say that since Volcker, or maybe longer? In the books, secular disinflation, right?
Sure, I think that's a fair point to make. But I would point out that we've seen a inflection point in terms of the Fed's approach to inflation. Before, the Fed was very prohibitive. They were proactive in trying to combat inflationary pressures. Since the onset of the pandemic, they moved to average inflation targeting framework. And what we saw is the Fed become complacent on inflation, and they allowed inflationary pressures to build and build. And that is why we find ourselves in the situation where we are now, with headline inflation at 7% and core inflation above 5% year over year. So we've moved from an era of disinflation to an era of inflationary pressures becoming more entrenched because of this complacency by the Fed.
Shepard Smith here. Thanks for watching CNBC on YouTube.